Something unusual just happened in Jackson Hole. Powell signaled a possible rate cut in September, but at the very same moment he unveiled a new Fed framework, rewriting rules that were designed for a very different world. Back in 2020, during the pandemic, inflation was low and the bigger risk was a weak labor market. So the Fed tilted its framework toward prioritizing jobs, promising to offset shortfalls in employment, even if it meant tolerating a little more inflation. But the environment has changed. Inflation is now sticky, tariffs are raising costs, and jobs are cooling at the same time. That's why Powell announced the Fed is going back to basics, balancing inflation and employment equally. And here's the dovish twist. With inflation still above target but not spiraling, and the labor market visibly softening, this balance actually gives Powell more cover to cut rates if jobs weaken further. In other words, the framework shift wasn't about tightening. It was about creating space to ease without looking political. But here's the real trap. Tariffs are clearly pushing prices up. That's a level shock. Normally those fade, but if they bleed into wages and services, they can become persistent inflation. At the same time, the labor market is slowing in a strange way. Demand for workers is falling, but supply is shrinking too, thanks in part to immigration restrictions. That's why Powell called today's labor market curious. Job growth has collapsed to around 35,000 a month, but unemployment is still just over 4%. A slowdown without a total break. So the Fed is stuck between two fires. If they hold too long, jobs crack. If they cut too soon, inflation risks reigniting. And here's where the retail sector gives us a window into the problem. Walmart, Target, and other big names are still reporting sales growth, but their stocks are falling. Why? Because margins are getting squeezed. Consumers are trading down, and companies can't fully pass on costs. That's the paradox we broke down in our video. Sales are up, stocks are down. Powell blinked. And it's exactly the kind of signal Powell is watching. If earnings keep showing strong sales but weak profits, the Fed knows inflation isn't the only risk. Demand fragility is too. And then came the politics. President Trump threatened to fire Fed Governor Lisa Cook over alleged mortgage fraud. A supporter confronted her in the lodge lobby before being escorted out by police. Security at Jackson Hole was heavier than ever, with armed officers patrolling the grounds. This wasn't just an academic retreat anymore. It looked like a political flashpoint. Why does this matter? Because markets can start to price in an independence premium, a risk that long-term treasuries demand higher yields if the Fed is seen as politically compromised. You can see the signs. Powell's dovish hints pushed the euro higher against the dollar, while long-term US yields stayed sticky. That's the tell. So what happens in September? Powell has opened the door to a 25 basis point cut, but don't mistake that for consensus. If they cut, expect 2 or 3 hawkish dissents. If they hold, expect the doves to break ranks. Either way, unity is gone, and that itself is a signal. Scenario 1. Cut now, frame tariffs as a one-time shock, and hope wages don't spiral. Scenario 2. Hold in September but risk a bigger scramble later if jobs crack harder. The choice isn't just about rates, it's about the credibility of the Fed. Here's what really matters for you. Between now and the September 16 to 17 meeting, 3 data points will define the path. First, core services inflation. CPI on September 11th will show whether tariffs are bleeding into sticky services like healthcare, insurance, and transportation. If that jumps, Powell's room to cut shrinks fast. Second, jobs report. On September 5th, the unemployment report will show not just the rate, but the absolute number of people gaining or losing work. Immigration shifts mean the Fed needs both numbers to judge the real slack in the economy. Third, jobless claims. Weekly claims on September 12th give Powell a near real-time stress test. If claims spike, he has cover to act. If they stay low, doves lose part of their case. And here's the added complication. Recent leadership changes at the Bureau of Labor Statistics have raised questions about whether future jobs reports could shift from monthly to quarterly. For now, the September 5th release is still scheduled, but the credibility and consistency of U.S. labor data are in focus. That uncertainty itself is part of the Fed's trap. And that's why this year's Jackson Hole was so different. Powell wasn't just giving another wonky speech in the mountains. He was sketching out the Fed's final stand for independence before politics reshapes the institution in 2026. For the world, Fed independence isn't just principle, it's plumbing. It's how global credit works. And if that anchor loosens, the cost will be felt far beyond Washington. So the real story isn't will Powell cut? It's can the Fed stay independent long enough to navigate the trap of tariffs, jobs, and politics colliding all at once? That's the road ahead, and the markets aren't ready for it. If you found this valuable, share it with a friend who still thinks Jackson Hole is just a central banker retreat. And subscribe to Global Notes by JP. Weekly macro, no hype, just details and second-level thinking.